Hey everyone, and welcome back to the channel. My name is Hamish Holder, and today we're doing stock market Q&A for the month of May. I really don't like how that rhymes, but anyway, we're up to May, and I've collected all of your questions from the bottom of last month's video and from the post that I just made a couple of days ago in the community board. Of course, if you have a question for next week, make sure you leave it below this video or leave it on the post that I make in the community board, which will be in 1 month's time. But without further ado, let's just get straight into the questions because that is what you're here for. So the first question we had here was from Jake, and he asks, what is more important when analyzing the value of a company? Is it the return on capital, the return on equity, or the return on assets? And so what you'll notice, the first thing that I'll say is that you'll probably notice that the percentage number that you get out of all of these will be very similar for most companies. And the reason for that is because, well, the first one is that capital, the denominator of return on capital and the denominator of return on assets, which is assets, those two numbers are very similar. There's not a huge amount of difference. Return on assets obviously includes all of the assets on the denominator, and on the top there'll be some kind of profit metric. Sometimes it's free cash flow, sometimes it's income from operations. And then on return on capital, the top will be the same, but at the bottom it'll be capital, which is sometimes equity plus long-term debt, or sometimes it's total assets minus cash and a couple of other things that are not considered capital. But generally speaking, return on capital and return on assets will be very similar. And then you have return on equity. Now, this is the one that can differ from the other two because this is just equity. It's not all of assets. It's only the equity side of assets. It does not include looking at their debt. So if a company has a large amount of debt, then their return on equity would look a lot better than their return on assets. For me personally, I just like to look at return on capital because I like to look at all of the money that they're investing within the business, whether that's equity, meaning whether that's retained earnings, reinvesting profits, or whether or not that's debt that they've taken on. I want to look at all of the capital that they're investing and compare that to their profits. So that's why I like return on capital, very similar to return on equity, very similar to return on assets, but all of them are important to look at. And we also, of course, want to see that all of these are very strong at 10% or more over the long term and consistently getting better, which would indicate to us that their investments within the business are improving over time. The next question we've got here is, what do you think about Intel stock? So in terms of Intel stock, I've never really looked into it just because it's in an industry that, one, I don't find that interesting, and two, I don't understand the industry that it operates in. I know a small amount about what Intel does, but I don't know much about the operations of that kind of business. I'm much more competent in understanding the operations of a restaurant industry or a caravan industry than a chip maker industry. So for that reason, I really haven't looked into it, so I couldn't give you any more thoughts than that. But I would say that my opinion on that stock, or any stock for that matter, really doesn't matter. What matters is the approach that you take to it, meaning that you need to understand the business and you need to be confident in the future cash flows of that business. And if you're confident in the future cash flows of that business and you've come to a rational conclusion, then you can rationally work out how much you want to pay for that stock. The next question we've got here is, I'm waiting for your second part of the Thor Industries analysis. Yes, the Thor Industries analysis is now out. So I did a 2-part full analysis of Thor Industries. It's a 1-hour video combined of the two parts, and the second part is out on the channel now. So if you're interested in seeing my full stock analysis on Thor Industries, goes for an hour between the two videos, then go check that out on my channel. The next question we've got here is from Don, and he says, "Hi Hamish, I love your content as usual. My question is a bit of a weird one. I'm currently looking at the market at a macroeconomic level. While the markets in Australia and the US are overpriced, I believe that there might be an opportunity soon in the UK markets due to Brexit. Can you please suggest how to identify good businesses using a screener without needing to look at businesses one by one?" Yeah, okay, so you're still going to need to look at businesses one by one individually. You're not going to be able to get a screener that just gives you all of the stocks you should invest in. You're still going to need to go through that short list that your screener comes up with and go through them and tick them off or cross them off the list. But in terms of what to put into that screener to initially get a short list, I would generally start with looking at companies that are at least very old. So they've been around for at least 10 or 20 years on the market. I'm looking for companies that have relatively low levels of debt, and I'm looking for companies that have consistent growth in their earnings and their revenue, and in maybe in their equity, and hopefully in their free cash flow. Depending on what the screener does, you may be able to enter in some of those, but I'll generally look at the growth rates over the past 5 or 10 years, and I'll be looking for screening companies that are consistently increasing their profits. And then from there, it's just about starting from the beginning of our analysis, which is we need to make sure we understand the business. So when you're looking at your short list on the screener, when you look at the stock, do you understand that industry? If you don't worry about it. If it's in biochemistry, or if it's in pharmacy, or if it's in banking and you don't understand it, just leave it. If it's a restaurant business or it's some kind of retail business that you think you could grasp quite easily, then go and have a deeper dive into it and just slowly go through one by one. I actually made a video on my channel a little bit earlier in the month going through how I screen stocks and how I go through them one by one. So if you're interested, go check out that video as that will give you a guide on what my approach is to shortlisting businesses for my further analysis. The next question that we have here is from Nightsight. Hi Hamish, the US debt is rising every year. Do you ever think that they'll start paying it off, or do you think they'll continue into infinity? What will happen to the stock market if the US defaults on its debt? Okay, so I will just start by saying I'm certainly no expert in this, so my opinions could definitely be wrong, but from my understanding of the situation, the US has a lot of debt, but they have a lot of debt in US dollars. So it's very unlikely that they're going to default on that debt because they can just print more money and pay it off. Now that would cause a huge amount of inflation, of course, but it's very different from that kind of situation to where a country has a lot of debt that's denominated in a foreign currency. Those are the countries that are at risk of defaulting. I don't think the US is one of them. However, in terms of the overall level of debt, of course, they need to pay it down. Whenever a country or a business or an individual takes on debt, they're borrowing from their future self. So you're taking money from your future self and you're using it today to buy something. And then, of course, in the future, you need to pay that back. So you can't just keep taking on debt into infinity, because there's a tipping point at which the interest payments on that debt is too much. And that's the point at which you need to cut back spending on an individual level, on a business level, and on a government level, cut back spending and pay down those debts. And that will ultimately, that's generally how the debt cycle works, and it generally causes an economic recession. But as I said, I'm no expert, so I have no idea. I'm not going to be able to predict when they're going to have to start paying down their debt, or when they're going to have to start taking the steps that it may cause a recession. I have no idea about that. I just have a basic understanding of the debt cycles. Ray Dalio has a great video on understanding it. If you want to go check that out, it's called Understanding. He has a book called Understanding the Big Debt Cycles. And he also has a video on YouTube called the Understanding the Economic Machine, or something like that. So go check out those videos if you're interested in further looking into these topics. The next question we've got here is from Colored. Hi Hamish, when do you sell a stock? Aside from the obvious capital gains, when you sell, can you hold a stock for decades and live during the good, bad, and ugly times? Yeah, so generally speaking, I'm going to be looking to be a buy and hold investor, meaning I'm looking for stocks to invest in that I can buy and that I can continue to add to that position over many decades. Ideally, it's a company with a wide economic moat, a great management team that's going to be there for a while, that I trust, and that is effective at investing within the business and managing debt. And that the stock is often, well, most stocks will fall into this price range. They'll fall into a price range where they're attractive. And I'm looking for businesses that I can hold over a very long period of time. And throughout the sort of the volatility of that stock over many decades, there will be times when it's cheap and I'll pick up more stocks. And that's my ideal situation. I'm not looking to use the stock market as an income source. I'm looking to build wealth there. So I'm not looking to buy stocks and sell them for a capital gain and use the capital gains as income, or buy into only dividend paying stocks that pay out all of their earnings as dividends. I'm just looking for the investment vehicle that is going to compound my money at the highest rate. And whether that's a dividend payer, or whether that's a part dividend payer and a part investor, or if it's a complete stock that just completely invests, I would much prefer to invest in a business that I don't need to ever sell, one that I can just continuously add to. And the final question we've got here for today is, hi Hamish, I always enjoy your videos. I have a question that always intrigues me. Every morning at work, I check the opening prices of my investments, usually at around 10 a.m. Adelaide time. I often see that the opening prices are below yesterday's closing prices, or higher than yesterday's close. Why isn't the opening price equal to yesterday's price closing? That's a good question. And to be honest with you, I don't know. I've never looked into this. I would just assume it's got something to do with the first sale of the day. I'm guessing that the first sale of the day starts the opening price of the market, and that might be different to the previous selling price, maybe on the previous day. But I don't know. And the reason why I don't know isn't because I'm incompetent. It's because it really doesn't matter. There's a lot of sort of intricacies that when I was starting out, I was really interested in learning about all these things. Like, what does the bid do? What does the ask do? What's the relationship between this? What's the volume mean? And these are things that really don't matter. What I realized was that I do far better when I just forget about all the noise and I just concentrate on what matters, which is understanding great businesses and investing in them and making sure that you're only investing in the greatest of businesses. That spending all of my time doing that has been very successful for me. And I don't think that understanding little things like that really give you any edge over anyone, and in fact it might actually disadvantage you because you're spending your time looking at those things instead of focusing on what matters, which is looking at the underlying businesses. Now I understand your question is you're probably just curious like I am, so I'm probably going to look this up afterwards, but unfortunately I don't know the answer to that, and I gave you my reason as to why I don't understand that. But thanks for the questions, and thank everyone for leaving a question this month. If you do have a question for next month's video, then make sure you leave it down below or leave it on the post that I'll be making in 1 month's time. So that is all for this month's questions. And of course, if you're new around here and you want to see more content like this and some of the other content that I post on my channel related to the stock market, then please consider becoming a subscriber and hit that like button or leave a comment, do whatever you want to do. All of those actions really help the channel out a ton, and I appreciate the support from everyone out there. But for now, guys, I will see you in the next video.